The earnings credit rate, ECR, is a key metric used by banks to calculate the earnings credit that deposit account holders can earn on their balances. It represents the rate at which a bank credits interest or earnings on the average balance maintained in a deposit account, typically a business checking account. Key points about the earnings credit rate ECR include: 1. Calculation. The earnings credit rate is expressed as an annualized percentage rate, APR, and is applied to the average daily balance maintained in a deposit account over a specific period, such as a month. The bank calculates the earnings credit based on this rate and credits it to the account holder's account. 2. Usage. The earnings credit earned through the ECR is often used by banks to offset or reduce the fees associated with account maintenance, transaction processing, and other banking services. Instead of paying fees directly, account holders can use the earnings credit to cover these charges, effectively reducing their banking costs. 3. Relationship with account fees. Banks typically offer business checking accounts with a variety of features and services, which may be subject to fees. The earnings credit rate allows account holders to offset these fees by earning credits based on their average account balances. The higher the earnings credit rate, the greater the potential for account holders to offset fees. 4. Variable rate. The earnings credit rate is not fixed and may vary over time based on market conditions, interest rate fluctuations, and the bank's pricing policies. Banks may adjust the ECR periodically to reflect changes in market conditions and ensure competitiveness in the marketplace. 5. Negotiation. Some banks may allow business account holders to negotiate their earnings credit rate based on factors such as account balances, transaction volumes, and overall relationship with the bank. Negotiating a higher ECR can provide businesses with greater earnings credit to offset fees and reduce banking costs. 6. Transparency. Banks typically disclose the earnings credit rate and its calculation methodology to account holders as part of their account agreements and fee schedules. Account holders can review this information to understand how their earnings credit is calculated and how it impacts their banking relationship. Overall, the earnings credit rate, ECR, is an important factor for businesses when evaluating and managing their banking relationships. By earning credits on their deposit account balances, businesses can effectively reduce their banking costs and optimize their financial management. Understanding the ECR and its impact on account fees is essential for businesses to make informed banking decisions and maximize their financial efficiency.